I've been sunnier in disposition the last 2 quarters. I would say lots of clouds right now, and we'll get into why.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I often emphasize that the most useful people to interview are asset managers because they don't have the luxury of merely having an opinion on the road ahead. They have to commit capital to their convictions and be judged upon the results. Today, we've got the great fortune of having the return appearance of one of the most respected capital allocators in the business, Jan vanEck. Jan is CEO of vanEck, an asset management firm with over $100 billion in assets under management invested across a wide family of ETFs and funds, spanning equity, bond, commodity, digital, and regional asset classes. As we've done in the past 2 quarters, Jan and I will spend the next hour discussing his latest macro and market outlooks, as well as where he sees the biggest opportunities for investors right now. Jan, thanks so much for joining us today.
Good to be here, Adam.
Jan, this is becoming a fun recurrence here of every quarter, getting to see the world through your lens in terms of where you see the puck heading and where you see opportunity in the markets. We've only done this for the past 2 quarters so far, but I think I can say, based upon just that short track record so far, your calls have been pretty good. So congratulations. You are now here back at the end of the year. We're about to head into a brand new year. You've got a brand new outlook for looking into next year. So we're going to go through the slides that you've just prepared in a moment. But in a nutshell, as you look forward to 2025, is there a key theme or a key adjective that comes to mind?
I've been sunnier in disposition the last 2 quarters. I would say lots of clouds right now, and we'll get into why. So I'm not saying go risk off because, we kind of live by the theory of you want to stay invested in the financial markets. Timing is very difficult, but we'll talk about that, but a little bit cloudier than the last time we spoke.
Okay. All right. Well, look, why don't you start pulling up your slides then? Because I could ask some initial questions here, but honestly, I think everybody's just excited to see you roll up your sleeves and get into the meat of it. Let's find out. What clouds are you seeing, and what do you think we should do about them?
Well, I've entitled this outlook "At the Doorstep of the Reckoning" because what you and I have talked about before is the big fiscal reckoning, the big government overspend, and how that should be impacting our portfolios and how it's been impacting the economy. And I just think that we've got one big risk out there in the U.S. To the financial markets, which is inflation. And so that's really what I'm going to talk about. But the way I approach the markets is not just to look at the noise within the financial markets or today's headlines, but to try to take a step back and say, all right, what's going on in the world from a macro perspective, political, economics, or technology, and how should that shape our portfolios? So very much the vanEck investment philosophy, we call it a macro philosophy, Adam, as you know, is to look at what's happening in the world politically, economically, and from a technology perspective. And how is that from a multi-year view affecting your portfolio? Because we don't know what's going to happen this afternoon in the markets or next week or next quarter necessarily, but I can feel pretty strongly that there are some larger trends that you have to incorporate in your portfolio today. So that's what I'm going to talk about. If you look at the words on this page, it's not that these are new concepts, right? AI, the Fed, but where are we now in terms of timing? And that's where I think that's where the rubber meets the road in terms of how you want to adjust your portfolio. So that's kind of our philosophy, and I think it's given us some pretty good insights in the past. So first of all, period trend of Fed loosening. Is that really going to be the trend? And I think not. And the reason is because inflation is really much more present and much more of a risk to the equity markets and fixed income markets. So that's the first thing I'm going to talk about. I'm going to talk about where we are with gold and Bitcoin. They've acted as brilliant hedges to the risk of inflation, the risk of government spending. Do we want to take profits now that Bitcoin's over 100,000 or not? What about gold? And then AI, I think we're in a completely new phase of AI. So what does that mean for your portfolio? Where do you take profits? And lastly, international. Should we be looking overseas? My short answer is yes, because I'm worried about the valuations of the US market. So let's get into it.
All right, those are all great questions, by the way. I've been hearing a lot of the viewers of this channel ask those questions just in the past couple of days, so very timely.
Yeah, listen, it's funny. I asked some of my colleagues about this talk today, and they said what their clients are asking about, everything is the new administration and all the different kinds of policies that'll be hitting the markets and how to react against those. So that's the first thing I want to talk about. So let's talk about it. So as I've been saying, this chart basically shows in the blue line that our government deficit is around 7.5% of GDP. That is what I call 2 feet on the gas pedal. And that's described why our economy has done well. We didn't have a slowdown over the last year or two. It also is that inflation has been higher for longer. And that's why interest rates have been higher for longer. And I'm still in that general camp, right? That's what's been happening with the 2 feet on the gas pedal. Now, how is that changing? Well, we actually had a huge surprise this quarter. When you and I talk about what happened over a quarter from a multi-year perspective, usually there's not that many things, but it was a big election surprise. Why was it a surprise? Number one party won control over the federal government, right? The House, the Senate, and the presidency. Number one, that was a surprise. But number two, within hours of that victory, they said they're going to start addressing the budget deficit. I mean, who would have thought that this slide that I keep talking about, this fiscal reckoning of 2025, that they actually would have immediately pivoted in what I call the Trump-Musk administration in dealing with government spending. So that to me is a very good news in a general sense for de-risking what I call the 2025 reckoning. And before I get into the other slides, I want to explain why 2025 is so important. In US politics, you really get the best opportunity, even with a split government, of making major policy changes the year after a presidential election. And we have a lot of fiscal spending issues. We're not even going to talk about Social Security and Medicare and Medicaid today, but those are big spending issues as well. Anyway, that's why this year is so important. And so let me address my assumption and explain kind of where I think we're at. So my base case here is that the DOGE, agency or whatever you want to call it, is going to be able to cut $500 billion or $500 billion. It will obviously take them a little while. So I define that as the fiscal year starting in next October. So some would argue, well, spending is naturally going to increase to 250 billion. So they only have to cut 250 billion. Either way, that's a big number. It's not Elon's 2 trillion number, but it's a big number. And I think the financial markets would like that. I will say that on Kalshi, which is this betting site, there's a big split. Can they cut that much money? Kalshi says yes. 2/3 of the voters on this voting site, this betting site, say yes, they can cut that amount of money. And they interestingly defined it pretty much exactly the way I have. I would also suggest that viewers, if they want to track this fiscal issue, follow Vivek Ramaswamy. He is giving the blueprint for how they get there. And one way is to avoid Congress and stop 1,200 spending programs, which I think they'll call illegal or not authorized, on a day one basis. I don't know if this will happen, but that's kind of my base case. Obviously, if they fail to cut spending, we're going to have more debt in the US. And when I mean like more debt, right, at 7.5%, France is only at 5% budget deficit, and that caused their government to fall, right? So just to put in perspective, these are very unsustainable numbers. And a failure in this area would lead to more inflation, higher rates, bad for financial markets. I like to look at this chart, which shows credit default swaps, but it's basically a higher number is a higher percentage of money bet that the federal government will default on its debt. You can see, obviously, it spiked during the financial crisis. It spiked when we started putting both feet on the gas pedal with the Biden administration, and you can see how it dropped not insignificantly at the election. So, in a way, less inflation risk. But let me give you some countervailing facts. Let's
All
say
right.
that
Hey,
we,
real quick before you go on there, can I just ask a couple of questions, just clarifying ones here?
yeah,
Um, so when you're in your base case here talking about 500 billion in cuts that Doge is going to make, um, is that 500 billion net less spending? Or, some people have said, I don't really know if these, like a lot of things Trump wants to do is also going to cost money. And is this going to be more like um, rejiggering or redistribution, right? Like, yeah, the money might still get spent, but we're going to take it away from the wasteful programs and give it to where it's really going to have a high ROI.
I mean, this is a net overall cut in spending.
Okay. So
So,
if it's a net overall cut in spending, there's definitely an argument that can be made that a lot of what has sort of propped up the financial markets has been this high liquidity that's been provided through all this deficit spending. Why wouldn't that have a negative impact on markets?
it could. I would say that half a trillion, sorry, is not enough. So again, you're not talking about eliminating the budget deficit. You're just
Yeah.
talking about pointing it in a downward direction. I think that's a great question, and that's why I put my base case down there, right? If we actually cut $2 trillion, which Elon's talking about, that would definitely, I think, cause more of an economic slowdown. And if you remember, then my scenario was the Fed cuts rates dramatically.
Yep.
So that's really funny, Adam, that sort of the two scenarios I put on there are not good enough for you, that you want the third scenario where they actually cut more, which I should have put down, right? But if they actually were to cut more, then I think the Fed would cut rates to kind of put in more liquidity, as you pointed out, would be pulled out with that much fiscal cutback.
Okay, so let me just re-ask my question again because I wasn't actually going to the 2 trillion, but I'm glad you clarified that, which is okay. That starts to send things into shock, and the Fed would need to step in and maybe QE and all that stuff. I'm talking more just about the change in the impulse, right? Right now, the deficit impulse, if you will, has been positive. It's been growing the past couple of years and been pretty robust. Even a quote unquote small cut, and I hate to, my brain's rebelling at calling 500 billion small, but I get what you mean. But that's still that would be a negative impulse. Maybe not a big negative impulse, but it would be a pretty big shift in impulse, correct?
No, I don't.
No,
I don't think
okay.
so. I think as I said, I called it 2 feet on the gas. I still think it would be 1 foot on the gas. So I still think it would be this is my base case.
Yeah.
But I still think it would be, the government still would be spending a lot of money, borrowing a lot of money, and I don't, in this base case scenario, I don't think interest rates fall that much. But let me get forward, and then we can flip back to that if that's helpful.
That's fine. What I was trying to get here, and again, you'll clarify as you continue to answer, is there a chance that whether Doge cuts or fails to cut, that it could have a negative market outcome in both scenarios?
I would think a failure is definitely negative.
Yeah.
That's definite. And I don't think that I don't think larger cuts are at all possible, but if they were to happen, I think the Fed would offset that with more stimulative monetary policy.
Got it. Okay.
So, like, if you wanted to be super, like, simple, right? Monetary policy has been a foot on the brake, and they've had 2 feet on the gas pedal because of the government spending. So if they actually took both feet off the gas pedal, then I think the Fed would take its foot off the brake.
Right. And just to be even super clear, it's been the Fed with a foot on the brake and the fiscal side with both feet on, right?
Correct. The White
And
House.
and by the way, the day we're recording this, I don't know if you saw, but there was a mea culpa issued by Janet Yellen, essentially saying, "Yeah, I'm feeling kind of bad at the end of my tenure that we really didn't get, you know, our fiscal house in order, and our fiscal spending is not sustainable." Um, and it's kind of like, yeah, thanks, Captain Obvious, especially since you're the one driving the show. Yeah.
Well, yeah. All right. So let me just throw in something that people forget about. I think a lot of times is if we had an economic slowdown, like we're talking about nothing changes in the economy, but if we had an economic slowdown, that's going to drive that deficit right back up, right? And I'm even going to be modest here. If you look at prior deficit expansions in terms of GDP that are typically caused by recession, but then you have COVID down here at 13.2%, even a little minor recession at the low end of this, right? Like the 1980 or the 1990s, you're still talking about an increase in the deficit, right? So we need a lot of things to go right for this government spending to be net cut. Does that make sense?
Absolutely.
Okay,
It's almost as dependable as death and taxes, is that deficits are going to go up.
well, I don't know. Okay, so let's talk about some of the other things that are on the margin inflationary. So tariffs, I think, are very widely misunderstood, and I want to show you a chart on that in a second. Because when people hear the word tariffs, and you're economists, I don't know how about many of your guests, they say, "Oh my God, tariffs are horrible." And
Right.
if you look up, kind of worst tariff in the world, Smoot-Hawley, 1930. If you look up in Wikipedia now, like the third or fourth sentence is, the decade after, there was a 60% reduction in global trade, right? Basically, tariffs caused the Great Depression. Huge, right? 25% unemployment. So tariffs have been associated with really bad economic outcomes. I just want to point out, because a lot of people cite that, that is completely misleading. So I will show you this chart. So this is over that time period, right? The Great Depression, or this is the first half of the Great Depression, 1926 to 1934. What happened during that time period is not that trade, like units or bushels of wheat or corn, went down. It was that prices went down 50 to 60%. I'm not going to cite them all to you, but like farm products especially went down 60%, as you can see from this chart. So like when people talk about tariffs, it was at the same time that our collapse in money supply and the banking system caused prices to plummet, really had not that much to do with tariffs, right? Does that make sense?
Does make sense. And I know many are also pointing to, Trump's first administration where we had tariffs and we didn't get much inflation.
Yeah, we had low inflation, right? So anyway, but I just want, so people should kind of get the why. They don't necessarily matter, that much. But just to flip back here, listen, if there are significant tariffs, that's inflationary, very significant, that's inflationary. On the margin, there are so many other things going on. So I'm not going to kind of draw a super conclusion for tariffs, but I just wanted people to kind of know that it's not necessarily the big disaster, but it will have an inflationary shock. Some Fed officials say it'll be just a one-time inflationary shock and not systemic. Anyway, those are the things I want to point out. I would also say, well, we'll talk about China a little bit later on. So let me jump forward.
All right. As you do, let me just ask a question which you can answer throughout your presentation. You don't have to necessarily stop and answer it right here. It's just a question I've been asking many recent guests, and you're kind of putting your finger on it here, which is if we look at Trump's announced economic agenda, it's pretty disruptive, right? As you're talking about, big cuts with Doge, to the size of government, tariffs, or at least the threat of them, to negotiate better trade deals for America, the deportation of millions of undocumented workers, right? Whether you think it's a good thing or a bad thing, just a lot of those people are employed in today's economy, largely under the table. Can Trump be successful in all those things in the long term without some pretty short-term disruption and pain to the economy?
Yes, but I think uh, the risks are that, again, the whole thesis here is that there are many kind of risks to inflation not coming down further, which means that rates stay higher. And again, the backdrop here, Adam, I should be super clear about this, is US equity markets, right, on a valuation basis are super high. I didn't even bother showing you those charts because they're literally in the newspaper every day.
Yeah.
And you have every Wall Street strategist saying, next 10 years, you're only going to make 5% a year on equities. Another way of saying that, we've only in the fourth time in US history had two back-to-back years where equities have returned 25%. There's almost no chance it happens a third year, right? So that's the backdrop to all my comments. And I'm giving you the bullet that will shoot the markets. And the bullet is higher inflation.
Okay.
Or more persistent inflation. And so I'm trying to demonstrate this in a bunch of different ways. But so here, let's just look at what's going on with inflation. And what I point out here is we are a services economy. Even though people in the voting booth think about the price of hamburgers, the price of eggs being ridiculously high, and they did go up ridiculously high, those goods are actually over on a year-on-year basis down the price of goods. But services, and we're a services economy, what people get paid and a lot of different sectors are not coming down. It's still at 5% on an annual basis. So that's leading to sticky, kind of inflation. And to your point on immigration, so immigration will only support this line from going down, right? That this is my way of saying wages. Wages are again unlikely to go down a lot further, and that's exactly what Trump doesn't want. He wants wages to go up for workers, right? That's really the economic benefit that he's trying to give them. I didn't show a chart here, Adam, but it is great that the Biden administration has set two records in American history. One, we talked about budget deficits. And the second record, as we just learned from the New York Times, source of all truth, immigration. We've just had the highest immigration in probably in American history over the last couple of years of the Biden administration. So
All
not
right. And
only,
sorry, and when you say immigration, are you lumping both legal and illegal into that?
correct,
Okay.
correct. And so not only in absolute numbers, because you're just going to say, Jan, of course, the United States is bigger than it was in the 1850s. Of course, that number is higher. No, I'm talking about in percentage basis. We've never had immigration this high. If you look at the percent of immigrants in the United States today, people that were not born in the US, we actually just hit a record. It's never been that high, even after the immigration waves of Ellis Island in the 1850s and all that kind of stuff. Long way of saying that there's additional support to this chart, which basically says there's wages are still high, service inflation is still high. Don't expect, and that's a risk to the financial markets. So all of this is, I like to point out stuff that I think the financial markets are missing. Anyway, last, here is a minor indicator of inflation that's gone up since you and I spoke last.
Mm-hmm.
But this is trending absolutely the wrong way. This is a kind of internet verified kind of alternative inflation measure figure. I don't want to get into the details, but anyway, I'm really saying the same thing four different ways, which is inflation is a risk to the US equity and fixed income markets. And anyway, so people talk about short-term rates here as if they're going to plummet like a Niagara Falls here. And I just think, no, look at 1996. I think that's a much more likely. And our target for the end of next year is maybe you get a couple of additional cuts, but 10-year rates could easily stay in the 4.5% to 5% range. So anyway,
Okay.
base case.
A couple questions on this. So in a week, we're going to hear from Jerome Powell in the FOMC. Right now, I think from the CME online tool, market's giving like a 95% chance of another 25 basis point cut. In the immediate term, do you think they're going to continue to cut?
What Powell's been doing, I would just basically say is higher for longer. And he's been constantly surprising the market. It was later. Remember, it was supposed to happen in last year.
Absolutely.
It was supposed to happen in the first quarter. People were pounding the table.
Yeah.
It's just been higher for longer on interest rates. So I would expect him not to surprise the markets next week, but the general trajectory is higher for longer.
Okay. So it wouldn't surprise you if he, after cutting next week, sort of said, "Hey, everybody, I'm sort of slow in my roll here." After that.
I think that's what the evidence would support, right?
Okay. So a couple questions. One, just an observation. You're right, and I've talked about this for a year and a half now. How the market has been locked in a game of chicken with Powell over the past, almost 2 years about, hey, when are you going to pivot? And Powell generally, in almost every case, has said, I'm going to take longer than you, the market, think I'm going to. And the market's always had to reset his expectations. It has not mattered to market prices, though, right? For whatever reason, even though the market's been the one that's had to blink and move its benchmarks, stocks have just continued to go up. So that leads us to the whole high valuations point that you were making before. Let me also just note, the chart you're showing does not, so I totally get what you're saying, which is inflation is going to be stickier. You see a future of higher for longer, more like the 1996 kind of plateau versus a lot of these other, pretty violent, vicious declines once we've flatlined on the interest rate in the past. But this chart does not have recessions superimposed over it. And if we did do that, we would see in almost every case, when the Fed hiked and then plateaued, right as the Fed started to cut was when the recession would have been declared, and albeit retroactively. And the Fed is cutting because it's panic cutting because a recession's here. So do you really think we'll be more like a 1996, or is it going to be higher for longer until the recession arrives and then the panic cutting comes?
I think we're far from panic cutting. In fact, I think the economy is too hot right now, and that's partly what's leading to higher inflation. So I totally agree with what you're saying, and I think that's a point worth making is we're at low unemployment and higher GDP growth. If you look at current statistics, like they have the GDP now statistic, it's trending higher, right? Growth is actually accelerating. Business confidence is super high. It spiked after the election.
Yep.
And so I think everything is just too hot. And that's why I'm saying that the 2 feet on the gas pedal are also combined with a lot of exuberance in the markets. I don't need to talk about the crypto markets, right? So I think it's just that's what's kind of making me concerned. Those are all warning signs to me, Adam.
So on that point, it's just too hot. This question's been asked a fair amount, which is, then why is Powell cutting? Like why did he even start this cutting regime?
I think inflation was trending the right way, right? It's been approaching, if you look at the number of core CPI that they look at, it's been trending towards 2%. So I think that's why he's been hesitant, but he's been acting a little bit, I guess I would say.
Okay, but low unemployment, 3% GDP growth, it's been around for most of the year. Those are generally not levels at what you start cutting. Now, Powell was saying, oh, we're confident things are trending. Now maybe he's becoming less confident. But let me ask you this. Was he premature in cutting?
I don't, because it's not such a big move, Adam, I don't have a super strong opinion about that. I think I would be worried if he did a waterfall cut like you were talking about, if it were some kind of crisis response, because I think that's completely unwarranted at this point in time.
Okay. All right. Sorry to keep interjecting. I just know some of these are some questions that viewers would be having as you're talking here, but let me let you get back onto your procession here.
No, I mean, so listen, the traditional inflation hedges have been doing super well. And so the question that people should have is like, should I sell and take profits? Is the gold trade over? Is the Bitcoin trade over? And I would say, no, you're in a bull market, but you're going to get corrections, like 20% corrections in Bitcoin is like nothing for Bitcoin if you look at its history. or if you just want to look at gold. And so let me point out, sometimes the worst thing to do is just not ride the multi-year trend. And so I want to just remind sort of people why I think the gold bull market is part of a de-dollarization trend. And this is the chart of foreign central bank buying of gold. And it's effectively, look, it's a decade long. And what it is it's investors basically saying, listen, I'm happy to own dollars, but I need an alternative currency. And it's not the euro, it's not the yen, and it's not the renminbi. So I've got no other alternatives, but gold is that alternative asset. And so I think you've got the cyclical stuff happening in the United States with the Fed easing and all that, but you've also got this big trend. And I've talked about India, and we'll talk about that again a little bit. India is going to be as big as Europe in 10 years. They also do not want to be part of a dollar economy, right? And they are going to be buying gold as they get richer, and China just restarted its gold buying. So it's just, all I'm saying is you may get some fluctuations in gold. I think this is just part of a bull market. We have support from the 1970s, where what people forget is that actually inflation was a problem. It went away for a little bit and then it came back. And when it came back in the late 70s, gold did really well. So I think you've got plenty of argument to say you're in a bull market. There'll be corrections. There can be some violent corrections as there were here in the 70s, but to keep on to that position.
Okay. Does your base case look kind of like a 70s where you have this second wave of inflation?
Yeah, but not to the same percentage returns, but the same percentage of returns if the new government hadn't been addressing the big reckoning, the budget deficit.
Yep.
Because they are, I think you've got a lower trajectory of prices, but still positive.
Still positive. So Powell, who everybody has thought really wants to avoid looking like the second Arthur Burns, do you think he will end up looking kind of like one because inflation wasn't killed?
No, because I think he's going to be cautious enough in cutting rates. I think he exactly does not want to cut prematurely. And so that fits into my base case of higher for longer.
Okay. And I guess maybe I should just ask this, just asking you to guess. I'm not going to hold you to this, but like, where do you see inflation getting back up to at the end of the current trend?
That's a great question. We haven't really added it up. I would just say if it starts reversing direction, that'll be enough for the financial markets. And right now, as we sit here, you can take some profits if you're persuaded by my inflation risk scenario. Of course, people have a lot of capital gains, so I'm not saying exactly what the right thing to do is, but U.S. equities are really expensive, right? And I just think you just want to, especially large caps, be diversifying away from that, and you certainly want to hedge to inflation.
Okay. Last question on this. At what inflation rate do you think the market will start to visibly sweat? 3?
Core CPI 3.
Core CPI 3. Okay, thanks.
I think the market will suddenly, when they suddenly pay attention, I don't know about you, I don't hear about inflation a lot. When I started putting this, kind of our thoughts together, I talked to my colleagues, so these aren't just my thoughts. And it was surprising to me, several of them, inflation, just it's not really in the media, right? When people are talking about 2025, but a lot of people saw that as the biggest risk to the markets.
Yeah, I don't know. I just feel like the mainstream Wall Street is just kind of immune to it at this point in time. Oh, we had the inflation scare. Yeah, it's choppy, but it's over. It's all over but the crying. And it sounds like the people you're talking to are saying no.
Well, I think that's why higher rates would really upset the market enthusiasm.
Mm-hmm.
And it wouldn't take a lot, because then they're going to be like, oh, now then what, right?
Yeah.
And I think I forget who it was, but some people are talking about the Fed raising rates again. I think that I just think that would really surprise people.
Surprise folks. John, is this why you think the long end of the bond market is continuing to move up?
I think it's because of the fiscal reckoning and, you know, the 2 feet on the gas pedal.
But it's a concern about coming inflation that they're saying, all right, give me higher yields.
Yeah. Yes. Let me just point out to people that when I've said, listen, I'm concerned about inflation, I'm concerned about stocks and bonds, and the reason I put them together is in an inflationary environment, they can perform the same. So there's a lot of theories out there that, you know, government bonds are your hedge to US equities, and that's not necessarily true in an inflationary environment. If it's inflation that the markets are concerned about, you know, basically stock investors want higher dividends for longer, and bond investors want higher interest rates for longer, and they both go down. So anyway, just moving through this, you know, Bitcoin has gone through these halvening cycles, which happened in the second quarter of this year. That happens every 4 years or so. Usually after that, you get a several-year bull market. So if Bitcoin repeats itself, and look, the drawdowns are dramatic, it probably won't happen until end of next year or into 2026. So there's no reason to think that you're not continuing to be in a Bitcoin bull market right now from that prior kind of cyclical history.
Okay, so just to be clear then, the people that are saying Bitcoin just went from 50,000 a few months ago to 100,000 now, and this is all crazy froth mania, you're saying, yeah, maybe there'll be some near-term pullbacks, but 100,000 a coin doesn't seem crazy at the beginning of 2025. In fact, it might end the year higher.
Yeah, I mean, we're looking at this cycle, this, you know, again, defined by halvenings as Bitcoin going up to 150 or 170,000, something like that.
In 2025?
Well, yeah, basically 2025-ish, you know, bleeding into 26.
Wow, okay.
Yeah, because, right, if you have 3 years of a bull market, that's 23, 24, and 25, and then you'd have some kind of correction in 26, which would be the fourth year.
Okay. So what I take from these recent slides, Jan, is just, hey, look, stocks and bonds are correlated in a post-inflationary era, and you know, stocks are looking super rich right now, and you think that you know, if inflation continues to become more of a concern, that's going to, you know, cause a downward revision in both stock and bond prices for the reasons you mentioned. So therefore, own assets that perform well in periods of inflation. And looking at your recent slides, you think the bull market in gold is intact and the bull market in Bitcoin is intact.
Correct.
Got it.
Don't be distressed by this chart here. Just because they're the best performing assets doesn't mean you want to sell. And so let me give you a vision for 2025. Earnings are supposed to go up about 10%. I'm going to just simplify life. PE ratios could come down by 10%. So you have a flat stock market. Entirely probable. And that's kind of my base case. All right, can I talk about some of the other trends that are going on?
Absolutely.
Okay. So probably people have heard a lot about AI. I'm going to give you kind of you know, my take right now, which is that AI is kind of has benefited the semiconductor stocks and the mega cap tech stocks, and is now filtering in to help the rest of the stock market, other companies, and there are other ways of playing what's emerging as an explosion in demand for electricity in the United States. So we have nuclear energy, where suddenly there's bipartisan support of that, natural gas, infrastructure, grid build out, all these are going to be priced into the market. They have started to be and will continue to be because of our need for what I call phase 2 of AI, which is deployment by companies. And let me give you a statistic as you look at the chart of semiconductors here. This is an interesting quote from a Harvard study. 90% of recent US economic growth and 65% of the value of the largest 500 companies is accounted for by intellectual property, right? So we're in a world where it's not the manufacturing, facility that's on your, financial book value of your financial statements, right? It's all about your intellectual property. When you think about mega cap tech or creative companies, you think about new drugs that are going to be created. That's all intellectual property, right? So this trend of intellectual property, that is what drives our stock market. And I just think now it's going to be extended into the rest of the stock market. So let me and also demand for electricity. So let's just look at some slides here. Excuse me. So this is data center demand for electricity, and you can see, I'm not going to go through the details of the statistics, but from about a 5x increase in demand for electricity from data centers over the next 7 years. The nuclear energy has now gotten bipartisan support. It's amazing. Governors in California and Maryland and Michigan, Democratic governors, as well as the Biden administration, became pro-nuclear, which is a big change. You're also getting a lot of support from the hyperscalers, right? The Googles, the Metas, they all have cut deals to buy power from nuclear power plants. And I think we've all realized that the cost of electricity is super important as a competitive thing for U.S. economy. When we look at what's sinking Germany, it's because they lost access to natural gas, and the cost of electricity have skyrocketed. And that's killing their economy. So we have learned the lesson that we need cheap, reliable energy. And I think nuclear is definitely now part of the equation. So I don't think that's particularly new news, but there is a need for a bridging, because it takes, let's say, 5 or 6 years to build a new nuclear facility. And part of the beneficiaries of that will be natural gas companies who have rallied this year. And just to give you some statistics, this is incremental demand for natural gas. This is an estimate from a publicly listed company called Antero Resources. The green line is LNG exports. So in a Trump administration, we have a ton of natural gas in the U.S. They'll be happy to export it. So that's going to be a big increase in business there.
Right, and a ton of cheap natural gas. Yeah.
Yes. Mexican exports are going to go up a little bit, but AI centers are going to be a big demander of natural gas through their electricity demand. So I guess my point is, on the AI trend, we're at a different phase. It's no longer just NVIDIA's earnings. And you and I talked about this, but the stock, these semiconductors seem to be running out of gas. And the phrase I had used a couple of months ago was great companies, kind of not great stocks, because they were so overvalued. So you could see, listen, it's a great trend, and their demand growth and their revenue growth and profit margins are unbelievable. It's just that I think that from a valuation perspective, you're going to get more appreciation, and you actually have recently in some of these what I call phase 2 plays on nuclear, natural gas, and then electricity suppliers.
Got it. And just to restate that, maybe more simply, is you see the AI boom / wave continuing. There's just going to be a rotation of where the capital and the return on capital moves, and it's now going to move more to the energy suppliers. And the momentum that we've seen in the semiconductors is probably likely going to wane at the same time.
Yeah, and ordinary companies like vanEck, like our company, I see that. It took ordinary, when I talk to other companies, operating companies, AI sits on clean data. It took us all like a year or two to kind of better organize our data. But now, and Salesforce, you saw this with the Salesforce quarterly earnings, where their customer base is clearly very, very diverse. And they were all benefiting from the use of mining the data that's in the Salesforce databases. And so
Okay, got it.
that's the phase that we're in for 2025, which is good for lots of different parts of the stock market.
Yeah.
So let's revisit something we had talked about a little ways ago, right? Which is that probably the bell went off in the beginning of July, probably that growth had overdone it versus value, right? Because we saw this 20-year kind of peak. Now, I'm not saying it can't stay elevated, but that was a warning signal on July 1 that you need to start rotating out of sort of big tech into the rest of the market. We've seen that proven if you look at equal weight S&P as opposed to the mega cap tech heavy S&P. And here is my report card, Adam, from our first call, which is since July 1, the NASDAQ has been the worst performing index. Right? So you've got small cap as number one, the Dow, then the S&P, and then NASDAQ. And my call is basically this is going to continue.
Okay.
Right? We rang the bell.
Is it fair to say that you think that instead of talking all about the Magnificent Seven going forward for the next year, we're going to talk much more about the S&P 493, all the other companies that have been basically getting the short end of the stick for the past couple of years?
Yeah, this is a chart of the 493 effectively, right? Because it's an equal weight. Yeah, exactly. And this is another way of saying it. Now, listen, why did they succeed first? Because they own the US consumer, right? They own our social networks, they own our bookstore, they own our Amazon, our department store. So they were able to use AI quickly. Their data was well organized to improve the customer experience. And I think that'll continue. And that could be really good for their margins as well. So I'm not necessarily saying their businesses won't thrive. It's just that a lot of that had been priced into the market. And now other companies might get the benefit of that. All right, so that was, I think, the end of sort of our discussion of how AI was benefiting maybe the rest of the market. So it's a very powerful trend. There are obviously lots of things happening in the US market, but I think if you took the theory that mega cap tech had peaked on July 1, and I really think that diversification in your equity portfolio has played out since then, and I believe it will continue to. And I think I've got a good reason because they're going to get some of the benefits of AI. So let's talk about another place to invest. And I'm just going to make a couple of quick points, and then we conclude. So one is, let's look around the world. Where else would you invest? And my theory here is that we love index investing, right? The whole world investor community loves index investing. But in the international indices, I would argue, are really broken. And this is my example of China, which I borrowed from JP Morgan. It's actually been around for a while. But the point here is, in blue, China's weight in international equities peaked really as their market started to fall. And so this isn't quite as dramatic as it actually is, but it really increased the allocation to China at the exact worst time.
Right.
And so my point is, throw out MSCI. When you think about investing in the world, just start with a blank sheet of paper and you figure out what you want to own. Right. And so let me give you, my favorite theory. I'll just do it quickly, but that I'm going to pivot to India. I've talked about it before. This is a for sure best macro story in the world. In 10 years, it's going to approach the size of the continental Europe. And so this is the Indian stock market against the S&P over the last 5 years. So first of all, you're not sacrificing any performance by participating in this macro story. So, and why wouldn't it continue? Now, you've had with a little bit of a fall off in the market. It probably got extended. We can talk about valuations in a second, but my point is, if you're going to buy into this, you want to buy into dips, and you're getting a little bit of the beginning of a dip here. So that's what that chart says.
Okay. Hey, real quick, just any potential concerns from a diversification standpoint? that they're so tightly correlated, you don't get a lot of diversification benefit from adding it?
I think actually, I'm glad I think there's almost, they look like they both perform, but I think there's like the Indian economy fundamentally is completely separated from the US economy, right? They've got 1 billion+ people, consumers. They've got this sort of economic and political cycle that's not synchronous with the US at all. They're not dollar-based economy. So I really think, if anything, they're a great diversifier. Yes, okay, US global equity markets do tend to kind of track each other at a high level. But I think fundamentally, it's a very different story. And I
Okay.
guess my point, Adam, is why own 2% of India? Because that's what the MSCI index says. You could justify 10, 15, 20% of your international holdings. There's no rationale to these international equity indices. I'm being extreme, but
I totally get it. You're saying, look, make this a DIY strategy. Yeah.
yeah, yeah. Um, and anyway, here's valuation. So often they're high, but if you do it in terms of earnings growth for next year, India is actually cheaper on that basis. 1.4 PEG ratio for people that follow what that is versus the US market, which is 1.7 times. So it's cheaper, if you want to call it that way, for the unit of profits in India for 2025 than it is the US equity market is for profits in the US for next year.
Got it.
Anyway, here's another way of looking at, kind of how expensive India is. And I'm not going to say it's cheap, but you're getting growth, and it's not that much more expensive than other kinds of markets.
Got
So,
it. It sounds like you would say you'd be a buyer at corrections in the Indian market.
and we got one now. We're getting one now. All right, my last view. I know some people want to zero away China because it's uninvestable. I have two insights on what's going on in China. Number one is that the reason they're stimulating, and if you remember, I said in Q3, one of the great things about investing and why I was saying it's sunnier than it is cloudier is because you have the two largest economies in the world directionally using their money supply to stimulate the economies. And that's usually a great time to be invested. You did have this really sharp slowdown in Q3, and this is global manufacturing, but a lot of it reflects China. And I think that's why China is throwing the kitchen sink and stimulating its economy. So you've got that macro factor. And then the other thing that I've started to point out in China, and this goes to our trade tariff war with China as well. During Trump's first administration, if you look at advanced industries, technologically advanced industries, China was behind the US in 7 of 13 key industries as measured by Bloomberg. Behind in 7 of 13. Now, they are equal or ahead of the United States in 12 of those 13. And so all I'm saying is China is a global competitor in a lot of different industries. We've known now they're the number one electric vehicle manufacturer in the world. It's really causing a lot of problems for German car manufacturers. But it's just not the narrative you hear in the newspapers, right? You heard about, oh, there's this overbuilding of high-speed rail in China, and it's causing all these problems. Well, okay, maybe they overbuilt, but let's look at the positive side of that. They are the leader in high-speed rail in the world, right? Okay, maybe they overspent, but Xi Jinping is all over investing in technology and becoming a technology leader. And it just means that we're going to have tougher trade negotiations, with them coming up. So that's kind of it.
So on a net basis, Jan, just looking at, say, for the next year or so, are you net bullish or net bearish on China's prospects when it comes to China as a place to invest?
I'm bullish.
Okay.
I've been buying personally, so not, and in our global, we have kind of a global capital allocation model or global portfolio we call Wealth Builder. We've been overweight the US and we're now shifting to being overweight the rest of the world. And it's because it's inflation concern. It's what I've been talking about. US equity markets very richly valued. Inflation could be the bullet that causes it to correct. We've got a lot of inflationary things happening in Q1. And so where do you look around the world? The thing about China is you can say the property market has been dragging it down, but I just started buying last summer personally, and I think that we will be adding in our portfolios. We have been buying some, and I just think the downside is low. Valuations are really cheap. And there's some really good technology companies. And if you stay away from the companies that are highly vulnerable to tariff wars, I think that's a great way to go.
Okay. Let me ask you, is this your last slide?
It is.
Okay. Actually, first and foremost, in regards to these slides, I should have asked this before we turned the camera on, so sorry to put you on the spot here, but I know that folks would love to actually peruse the slides at their leisure. Would you be comfortable making them available to our premium Substack subscribers?
Yes, as always.
All right, thank you. Thank you. All right, so sort of last question on the progression you just walked through there. So there's a renewed optimism in the U.S., right? I mean, for the past 2 years, the U.S. has been the darling of the dance in terms of the global economy, right? It's been the one that's kind of been, doing in many cases by far better than the other players. It's where capital has gone, has flowed to. And our stock market has risen commensurately. And so it kind of seems to have all the advantages right now. With the conclusion of the US presidential election, Trump coming in, clear mandate, a lot of pro-business economic policies. We're seeing it reflected in the business confidence indices, even in the consumer confidence indices. Certainly investors are feeling exuberant, right? We're at record levels on the euphoria meter. I didn't even know such a thing existed, but it does, right? Do you think perhaps Trump's inauguration might end up being kind of like a buy the rumor, sell the news event, where we kind of get to sort of peak hopium around all this, and then people begin to realize, oh, wait a minute, inflation's proven to be much stickier than we thought. Oh, valuations are kind of crazy. Oh, there are better deals in other parts of the world. I know your theme here is lots of clouds, but could we kind of get to that peak euphoria and then realize, oh, wait a minute, the future doesn't look as bright anymore as because we got it to maximum brightness?
Well, again, I'd like to differentiate, and you can use whatever analogy, Main Street, Wall Street, whatever, NVIDIA, great company, but not necessarily great stock, right? So we're talking about investing in stocks and bonds. And so I'm not saying that the US isn't going to be a great place, that those companies won't have a great 2025. Absolutely, I'm very enthusiastic that they will. The question is how much of that is priced in. And when you have
it's value.
It's the US is the equity market is at record high valuations. And every major strategist has said, like, you're just not going to get a lot of returns out of equities. You look at history, all the evidence is just that you're not going to have a great financial investing year in 2025. And so do it now. I don't know if it's inauguration day. I don't know if it's a bad CPI print. I don't know if it happens in January or June. I'm just saying that the context for a lot of these things is that you're vulnerable. You're super vulnerable to a bad inflation surprise. I'm not calling for a 25% correction in US equities. It could be 10%, but I like to sleep at night. And for my portfolios, I want the inflation hedge, keep the inflation hedge, but also maybe start picking up some value pieces around the world.
Okay. And just on that concern, is your general concern right now heading into 2025 as an investor is that it's going to be a correction year and that's something you want to protect against, or is it just more like, it's going to be like a 5% year, right? Which isn't terrible, but compared to two 20+% years, it just looks and feels bad.
It's going to feel like a dud year.
Yeah. Okay. All right. Well, look, Jan, thank you so much for just this excellent walkthrough of how you see the world, taking the time to put together these slides, come on this channel, walk us through it. For folks that really enjoy this and would like to follow you and your work in between your appearances on this channel, where should they go?
Well, I'm on LinkedIn. VanEck.com has all of our investor insights. I'm also on Twitter, Jan VanEck number 3. So I comment once in a while on news and things like that. So, and I love this podcast, and I love to share these kinds of interviews that other people do, smarter people than me do. So so if you want that, that's what I post on LinkedIn.
Great. You're much too self-effacing, Jan, and you're welcome on this channel anytime. But I got to tell you, I know the audience really appreciates, but I very much value these quarterly updates from you. So we'll continue to do them for as long as you want to come on this program and provide them.
Awesome. Happy holidays, and good luck in 2025.
Well, now is the time in the program we bring in the lead partners from New Harbor Financial, one of the financial advisory firms endorsed by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Guys, thanks so much for joining. John, why don't we start with you? Great presentation there from Jan. I know that there's a pretty tight relationship between you guys at New Harbor and the folks at VanEck. I love to see when smart people work with smart people. What were some of your key reactions to Jan's slides there?
Hi, Adam. Great to be with you, and awesome to hear Jan talk again. We really like him and his firm. He is rare, I think, because many fund companies like VanEck really kind of straddle all sides of the fence. They're never willing to make a call, never really willing to put their neck out there and give direct advice or calls on markets, and really appreciated his comments. He looks at a lot of the same things that we look. Their role as architects of portfolios that can be used by folks like us here at New Harbor, tools, if you will. We don't think of these as products, but rather tools in our toolkit. And our job is to translate what's going on in markets and translating it to an application to our clients' everyday lives and what it means for their financial plan. And I will just give a quick plug for VanEck. We have used and currently use some of their tools, and they are a very generous firm in terms of providing deep thought and insight. We've had conversations with some of their portfolio managers in key areas, and they're very accessible, kind of like we like to be for our clients. So I want to thank Jan and his team for that. But he was notably different in tone than he was even 6-7 months ago. He described it, a lot of clouds on the horizon, and we absolutely will call out the same things and have for some time. Valuations in the U.S. stock market are at not just extreme levels, but the most extreme ever. You throw that alongside sentiment indicators that are just off the charts. Adam, I know you posted on your Twitter feed a chart that we shared internally in our team, looking at investor optimism about stock market gains over the next year and comparing that to their expectations for income increases from work and employment over the next year. And it was like a massive divergence there. They weren't so optimistic about their income, but they were super bullish about the stock market. Like, who cares if I don't get paid what I deserve? But hey, the stock market's going up, so everything. Yeah, there's the chart right there. So we're seeing massive shifts in sentiment, fund flows into U.S. equities. So we have been and remain rather cautious. We're about just under 40% allocation to equities, not including gold mining equities, which is another area that we like the folks at VanEck. But we do have belt and suspenders. We have hedges in place for a good bit of that portfolio. And we likewise see valuations being much more compelling in international markets. We like India. We have an allocation to India for many of the reasons that Jan articulated. But we're still holding a nice treasure chest, if you will, of short-term treasuries that are still yielding very compelling yields for sitting and waiting, which we do believe that we'll have a better opportunity as these clouds start to turn into showers and ultimately a rainstorm. It's a matter of when, not if, in our opinion. And we likewise share some of the concerns that Jan has about that rates are likely to be higher for longer. Just today, as we're recording this, earlier today, came out the PPI report, Producer Price Index, came out hotter than expected. And these are the prices that producers, manufacturers, and producers pay for goods into their process. So the concern there, of course, is that those prices get passed on and we see a reignition of consumer price inflation. But Jan pointed out that even things like service inflation and wages are persistently sticky here. And we likewise have a more tempered view on where rates are going to be. We don't think they're going to be dropping like a rock, like many people are wishing for. And in fact, it's exactly what we've seen since the Fed started cutting rates in September of this year. We've seen the short end go lower per their plan, but the long end curves, long end interest rates on 10-year treasuries and mortgage bonds and things like that have gone up dramatically. And we think it's probably in a trading range there and not likely to. So we're not very bullish on long-term bonds. We have very modest allocation there because we think we're in a trading range that has some upward potential. We agree that monetary assets, and the two most often talked about ones that Jan talked about today, of course, are gold and the newcomer on the scene, if you will, Bitcoin. We owned Bitcoin very briefly a few weeks ago for our clients, very small allocation. We have been long time bullish on bullion and precious metal miners. And Jan hit it on the head. There's been tremendous buying by central banks across the world as a de-dollarization measure, putting more of their reserves in gold. The World Gold Council, which represents gold miners, puts out a survey. There's a very, very strong theme through those surveys of central banks that they expect to continue increasing their gold holdings. And just now we've seen more recently retail buyers come into the gold market. So absolutely things got a little rich there in the short term, and every bit you can expect a pullback there without interrupting what otherwise we think is a very strong and durable bull market likely with us. Just trying to think about a couple of other things that he talked about. I think those are the main high points. Chock full of wisdom there and I'm really glad he covered the basis that he did, because those are really much the things that we think of as really impactful on markets and our clients' portfolios as the months tick ahead into the new year.
Okay. The one other thing that Jan talked about that I didn't hear you mention, John, was sort of phase 2 AI, and saying that it looks like the capital inflows are likely going to start to rotate, kind of away to going into the semiconductor space and more to going into the actual companies themselves. So I think maybe you did talk a little bit about this, that the more from growth to value, or more simply put, from the Mag 7 to the remaining 493 of the S&P 500, but also in particular going into the energy space. And he mentioned in particular nuclear and natural gas. Do you guys have any opinion on that? Do you have any exposure to nuclear or natural gas in your portfolio, or do you expect to, for the reasons that Jan mentioned?
Yeah, we absolutely think there's likely follow-on effects there. The hype and then the implementation. And you're not going to have data centers without a whole boatload of grid enhancements and reinforcements. Going back to my early days in the energy industry, and we know it's always talked about, our U.S. power grid is aging and really broken in some areas, and that takes a ton of capital investment. So we actually did own a slice of the nuclear space. We sold it earlier this year. It's kind of been pretty volatile since then, but we think long term it's likely to be a very important part of the equation, and we probably could foresee at some point getting back into the nuclear sector. We've owned utilities for a good part of this year. It's been one of the strongest performing sectors this year. These are natural gas and mostly electric utilities, wires companies, if you will. Some power generation utilities in there. The energy sector, natural gas and oil and traditional energy, as much as the valuations seem relatively compelling compared to most other sectors of the market, they have been really sluggish we look at what the market is telling us in terms of what sectors are in favor and catching momentum and the interest of investors, and the energy sector has been one of the most lagging and sluggish sectors. We'll look for opportunities as that starts to perk up, but we don't want to anticipate it before that buying demand starts coming in that sector.
All right, thanks. Here, Mike, let's pull you in here. So, John, thanks so much for the recap of your response to what Jan talked about. Mike, I just want to get an update from you. What is New Harbor's kind of current view on the market environment? And based on that, are you making any changes in your portfolio?
All right, so here's where the rubber meets the road. And Jan said he's more cautious now. John just reiterated the same. Here at New Harbor, we are cautious. I mean, how can you not be? We have evaluations that have never before been seen. We've got bullishness that's off the charts from American Association of Institutional Investors or Individual Investors, AAII, I believe it is. I can't remember which it is. Just came out at 62%, 62 point something. It's about as high as it's ever been. VIX is in the basement. Every single thing, and there's probably 10 or 20 we can list off that's extremely lopsided, yet it hasn't mattered. And so what do we as money managers do? We're trying to get some of the return that this market has to offer. At the same time, we don't want to give back much, if any, on the turn. And everybody would like that, I think. We'd like to time the top perfectly, but we can't. Our indicators are flip-flopping, sometimes from one week to the next. And most recently in the last week, and we promise here to share with your viewers some of the things that we're actually doing, nuts and bolts of what we're actually doing, because I think they're interested in that. Our indicators reverse back up. The NASDAQ, for instance, tech stocks showed renewed strength. The Mag 7 is starting to take off again. That flips some of our indicators back up. And we see a continued widening in participation amongst other sectors, most notably mid caps. So because of that, we added a few percent to mid caps. This is a small adjustment here. We're not trying to sit on the fence and saying we can have our cake and eat it too. We made a pretty strong positioning statement some time ago saying, hey, we're at around 35 to 45% here. We may miss out some upside, but that's okay. So we're very consistently focused on capital preservation, but we added a few percent to mid caps. The charts of the Russell 2000 are near all-time highs, and they're starting to participate. Having said that, nobody knows when this turn is. And today we have a down day. Yesterday was an up day. Gold and silver are down. Gold and silver miners have been increasingly frustrating. So I would say this, we've added a few percent to our equity exposure, but we're still in the 40-ish% range, like John said. Gold and silver are hard to hold on to, but we're hedged on half of our position. We have a put on our position, which predominantly is GDX, an ETF that this is not a recommendation, but happens to be what we're in. So we have a put on half of that at around the 38 level. So that's right where we are right now. So half of that is hedged. If we go down from here, where half our position automatically comes off. If we go up from here, we have our whole position. Gold itself and silver are stronger than the miners. That's been a frustrating thing that we think is going to change, but hasn't yet. And other than that, there hasn't been anything really earth-shatteringly big in the last week. I think that I think still that we're likely to see a move up based on the Trump election and the anticipation into the inauguration, but we're not making big bets based on that. That's just our guess, and so we'll see.
Okay.
I'll just add one thing there, Mike.
Yeah,
we have had for some time what we call out of the money tail hedge risks on the stock market. We've had out of the money put options on the S&P 500. Some of our very smaller accounts aren't large enough to use these tools, but for most of our accounts, we can use them in. And over the last year, the bull market, we've had put options at 5,200 on the S&P, 5,400, 5,600, and just recently, in concert with us increasing our equity allocation slightly, like Mike talked about, we moved those puts up to 5,800 on the S&P. So very relatively close to where we are in the market right now, not a whole lot of downside. And that's like an insurance policy on about 15% of our stock market exposure. That policy kicks in at around 5,800 on the S&P. So, we're very cautious, but we think we're in the right areas to harvest what momentum this market is showing us.
All right, and we talked about this the last time you guys were on the channel here, John, that the right now on a relative basis, puts are relatively cheap. I think, Mike, if I remember correctly, you said this wasn't the lowest time, but it was one of the lowest time in your guys' career or one of the times in your career that you've seen downside insurance like this being this cheap. So it looks like you guys are taking advantage of that.
Yeah, Goldman put it. I think it was Goldman put out a chart. It was looking at 1 month ahead cost to hedge the S&P, and it was like the lowest, maybe two or three other times in the last 25 years. They calculated it to be as cheap as it is now. That will change, of course, with the market. So this is not a enduring, not even a recommendation, but not even an enduring statement. The cost of those puts, just like insurance. If you buy insurance on your house, after it burns down, well, first of all, you can't get it, but it would be outrageously expensive.
Right, right. Well, look, my recommendation to folks watching this is that if taking advantage of the relatively good prices for downside insurance right now sounds of interest to you, and especially if you haven't bought puts in the past and aren't intimately familiar with how they work, highly recommend you follow the advice of a professional financial advisor on how to use them. All right, John, we'll stick with you as we wrap up here. One of the last times you were on too, we talked a lot about year-end planning, specific tactics, which folks really loved, by the way. We did, the new format with you guys last week, and the feedback we got from users was, this is great, keep doing it. So we'll keep doing that monthly format with you guys. But I think some of the questions I'm beginning to see in the comments now is, hey, I didn't listen to you guys. I kind of got distracted, the holidays coming up super fast. Is it too late to get year-end planning done now? What would you say to them?
Not at all. We still got what, 2/3 of a month here, and so plenty of time. We won't go through the whole checklist here, but just a couple that come to mind. Roth conversions or even partial conversions for traditional IRAs into Roths to take advantage of, say, for example, if you happen to be in a uncommonly low tax bracket this year, either because you took a sabbatical, lost your job, or whatever, has some losses that you could use to offset income. This could be a very wise strategy to get money into a Roth. You have until the end of this year. Don't wait till the last day, because the custodians that most people keep their money at, we keep our clients' money at Charles Schwab. They're going to get really busy, and you'll simply run out of time. But there's plenty of time right now. Just don't wait for the last few days of the year. And then, of course, opportunistically harvesting losses to offset gains. If you've realized gains or want to realize gains, and you have some positions that haven't quite worked out, great opportunity to reposition your portfolio, but do so in a very tax sensitive way. We try to do that for our clients, and it's plenty of time still to do that, of course, as well.
Great. And along with just regular rebalancing that you want to do to get the portfolio well positioned to enter a new year. So one of the things I just want to mention about Roths is a great thing to do is, if you've got kids that are, beginning to make some money, that they're going to be taxed on, what you can do is you can open a Roth IRA for them, and then you can gift them the amount of money to contribute to their Roth IRA. So I think up until the maximum of what a Roth IRA contribution is per year, I think it's $7,000 a year per person. I think if you're over 50, maybe you can do 8,000. But let's say your kid is making $7,000. You're opening a Roth IRA for them. You then gift them $7,000, which is below the annual gift limit. So you're able to give that to them with zero, impact on your lifetime gift allotments. And there's no taxable gift issues with the kid receiving it. But that counts as their contribution for the Roth IRA. So they can use that. Plus, they now have a fully funded Roth IRA for the year, which will hopefully grow tax-free for them for decades. And then when they take out the proceeds in the future, because it's a Roth, they'll be able to take those out tax-free. It's kind of a great win-win for everybody. But if you want to do that, you've got to both open the Roth IRA and certainly make your gifts into it before the end of this year. So just again, one of the examples of the many different good options you have available to you before the end of the year, but you got to take those steps and get it locked in before the deadline passes you by. All right, John and Mike, thanks so much for joining me for yet another week. Great discussion. Always great when Jan comes on the program. Folks, if you'd like to have Jan continue to come on quarterly, please let him know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you'd like some help with any of the things that we talked about here today, positioning for the type of year ahead that Jan sees coming, whether it's doing some of these year end planning steps that we've talked about. If you want some help with that, again, I recommend that most people watching should work with a good professional financial advisor to do that. If you don't have a good one already, or would like a second opinion from one who's well experienced, maybe even John and Mike and their team there at New Harbor, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds. You can then have a free financial consultation, portfolio review with these advisors. There's no commitment to work with them. There's no strings attached. It's just a free public service that they offer. Also, while you're over there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the website and sign up for our free Substack newsletter. And just a reminder, if you are signed up for the Substack for free, but have yet to upgrade to the premium, but are thinking about it, upgrade soon, because the monthly fee is going to increase on December 31st, heading into the new year. If you sign up beforehand, you'll get grandfathered in at the lower current rate. And just a reminder, if you're someone who signed up a long time ago and got the really low rate, your rate's not going to change at all. You're going to get grandfathered in as well at the current rate that you're paying. So again, want as many people to get as grandfathered in at the best rate as they can as possible. John and Mike, thanks so much for yet another week, guys. I know you're busy now with folks reaching out with year-end planning, but sounds like you still have capacity to take on more people. So folks, if you're watching and you haven't reached out yet, feel free to do so. But guys, look forward to seeing you next week. Enjoy the onset of the holidays, and everybody else, thanks so much for watching.
Thank you, Adam. Glad to be here. See you soon.
Thanks, Adam. We'll see you next week.